Good afternoon, and hope everyone is having a pleasant and warm December 9th afternoon. We're going to take a look at today's USDA crop report. As exciting as it was, we'll try to provide a little bit more for you to look at and consider here today. I felt like we would probably have a rather boring USDA report, so that gives us an opportunity to talk about some other things that we don't often have the time to talk about, and looking ahead to the future, including starting to look at the balance sheets for corn and soybeans for 2017 and 2018. May even talk a little bit about the 2017-18 wheat balance sheet going forward. But let's start off with a reminder. Once again, price is still a function of supply and demand, but is modified by the flow of money. We have to look at the perspective from which the trade sees this report. And I think today's market reaction is a great example of that. You get a crop report that doesn't change the domestic balance sheets. It increases global stocks, on reminding us just how big those stocks are, with a strong dollar making us less competitive on the global market. And lo and behold, we rally into the close. So let's take a look at some of those money factors that are involved affecting it. Here we have a chart. This is a weekly chart looking at the dollar index. Notice how it's broken out of the channel that had been in really since the beginning of 2015. So that's almost a 2-year period of time. And the dollar here recently broke to 13.5-year highs, saw a significant pullback. Well, I guess significant may be overstating it, but a noteworthy pullback. And then a reversal, a bullish reversal after trading down sharply yesterday morning following the European Central Bank meeting. It rallied sharply, was up 1% yesterday on the close, and then adding to those gains today, and now poised just below those 13-year highs, 13.5-year highs. So that has a big impact. Eventually, it should anyway, on the commodity sectors. We look back at history, that has tended to be the case, and we haven't accounted for that. And one of the reasons that this is an issue is look at the competing currencies. These are currencies of countries that we compete with in agriculture, and what they've done over the last couple of years in devaluing and going down in value. And when that happens, it makes our commodities more expensive to compete with them, and B, it makes their prices, if they're producing, once converted for their currency, higher than what we have. We may be at multi-year lows at the time when they could be at multi-year highs. So let's take a look at that. Here we have on the left a chart showing corn values. This is spot futures. That the darker line there shows values in terms of dollars, and the lighter colored line shows value in once converted to Brazilian reais. And so you can see there that they have a much higher price relative to what we do, providing them added incentive for continuing production. Now, there's other partial offsettings there, input costs that they have to import, certainly more expensive, inflation more issue. Look at relative to pesos. That shows that in Argentina, their corn prices are near record highs once you convert for the change in currency, because the peso is so cheap relative to the dollar. Here we look at soybeans relative to the dollar, the Brazil real on the left. Here again, near multi-year highs. And on the right, Argentine pesos, once again, showing soybean prices in Argentina at multi-year highs or close to multi-year highs at a time when we are at, well, not at multi-year lows, but just above multi-year lows. So it makes a significant difference when our dollar is going higher and their currencies are going lower. And that's just one of the ways. How does this play out? Well, here we have a graphic showing overall global land area devoted to the primary crops, combined world wheat, coarse grain, and oilseed harvested area. You can see the big increase in growth in area that we saw initially here when we had expansion in the United States and Canada, and everything leveled off for a period of time. And then we got to the 2000s, and we had another big expansion. We had the ethanol boom, but I want to say the commodity boom. There was more than ethanol involved in that, particularly as you go to Southeast Asia and look at the big expansion of the middle class there, and increase in per capita meat consumption. It required more grain and protein meal, certainly pushing prices higher and encouraging expansion of acres. Well, now we have a surplus, particularly in corn and wheat. We have a surplus here in the United States, but also to some extent globally. We'll talk more about that as we go. So the job of the marketplace in that condition is to take prices lower to discourage production and to encourage demand. So the U.S. market has done that. But when you account for currency exchange rates overseas, they're not reducing production, because when you take the currency exchange rate into account, the price is still encouraging expansion. So we're bearing the brunt of the pressure here in the United States to reduce production. And that's one of the problems faced by the market, is eventually we have to have global prices low enough to discourage production to get rid of some of these surpluses, unless weather does the job for us with short crops in major producing areas of the world. Now, as we look at the impact of the dollar, we see as the dollar's been rising, money generally flows out of the broader commodity sector, and this is the CRB Index. And I have this here to show a couple of things. First of all, you can see the inverse relationship. We've talked about this before. As the dollar goes higher, the funds sell the major commodity indices, and in this case, the CRB. But as we look at here recently, instead of going down as the dollar's been going up, it's really been chopping sideways, and it's largely been because the crude oil market. The CRB, as we look at what's circled here in the breakdown of the CRB, a little better than a third, about 34% of the CRB is made up of the energy sector. And of course, the energy sector has been getting a big boost because of OPEC's agreement to cut production. So that's been holding it up. You remove energy from the equation and look at some of the more equally weighted baskets of commodities, the other indices, and they're struggling more to even go sideways, a little bit more of a downside bias. And you take the strength out of the energy sector in those indices, and they go down. And so really, it's energy that's helping hold us up right now. This is a big weekend for the energy markets. OPEC has called a meeting of 14 oil-producing countries outside of OPEC membership or Russia. Russia's already on board with their cut, even though Russia's not a member. These 14 countries account for another 20% of production. If they get them to participate in reducing production, that's 70% of the world's production under an agreement to cut production. And that just is handing market share to the North American shale oil industry. So we'll see how we come out of the weekend, if they agree or not, whether the market is encouraged or discouraged coming out on Sunday night, Monday morning. That could have a big effect here on these major commodity indices and money flow overall. Today was positive, money flowing into crude oil. Now, I've said this before and shown this before. You see the updated chart here. The orange line is that same CRB index. Since January 2008, the shaded area is net fund ownership of corn, soybeans, Chicago, and Kansas City wheat. We see a correlation of 0.73. Anything above 0.7 is considered to be a significant correlation. So the correlation between the dollar and the CRB is a strong inverse relationship, and between the CRB and net ownership of corn, soybeans, and wheat is a strong positive correlation. Excuse me. This chart from finviz.com, if I can say it right, shows year-to-date performance of many of the different markets. Most of these are commodities, but there's a few that aren't. But look at the commodities in here, and you can generally see which ones have had significant gains this year and which ones have had negatives. The oilseed complex has generally done very well this year. It's certainly had better years, but generally positive. Corn and wheat are down here in negative territory. Now, these commodity indices, and I just showed you the CRB, they have an established weighting, and I showed you like the energy sector was 34% of the CRB index. Other indices are equally weighted. Every commodity in there has the same weighting. And so obviously, as a particular commodity rallies significantly during the year more than the others, it ends up at the end of the year with an unusually large weighting. And that has to be corrected. The opposite is true as well. A commodity that is very weak during the year relative to the rest of the basket is underweighted. And so they need to buy more of it to get it back up. And this takes place every January, generally between the 5th and the 9th trading session of the new year. And so we expect to see the funds, usually most noticeable at the end of the trading day, buying and selling various commodities depending on where they go. So anything in the green here, we'd look to see some selling in early January, and everything in the red, some buying. Obviously, other traders know this, and so they're positioning to offset that. And some of that positioning takes place late in the year, in the early days of the new year, so they're positioned ahead of time. The more they're in the green, the deeper in the green they are, the more selling is necessary. The deeper in the red, the more buying is necessary. So obviously this will change some more before the end of the year, but this gives you some idea of where we could see some buying interest come into corn and wheat and selling interest into soybeans here in the first half of January. Now, obviously, if you have a weather story that can overshadow all this, you don't tell it. But if the markets are otherwise pretty quiet, then it can be fairly noticeable. Today's crop report, we finally get around to that, talk about it. Up in the upper left-hand corner here, we see ending stocks, and the first column wheat, second column corn, third column soybeans, and you see that they changed nothing from the November report on the domestic stocks. The one exception is that they shifted some demand around, which we expected here at INTL FCStone. From some soft wheat demand, shifting that demand over to the hard wheats, but no net effect. We are expecting exports to pick up more for the hard wheats as we go into 2017, and maybe enough to boost overall export demand for wheat. But maybe the bigger surprise for me was considering the strength of this year's export campaign for soybeans, that USDA made no adjustment in its soybean export target. Specifically, marketing year sales to date of soybeans exceed the seasonal pace needed to reach USDA's target by August 31 by better than 150 million bushels, and the same is true of actual shipments for the marketing year to date. So that would have warranted at least a 25 million bushel increase in the target, but no, they didn't. And we'll talk a little bit more about that a little bit later. As we look at the world numbers, increases in all of them, higher than what was expected. We were expecting USDA to raise their Australian wheat production estimate by 4 million metric tons. They did a little better than that, came in at 4.7 million metric ton increase. Surprising they did not increase India's wheat imports. A lot of people in the trade thought they'd go from 3 million metric ton up to 5 million metric ton. Still expect that at some point, but here again, that just kind of partially offsets the increase in Australia. Brazil, they increased Brazil's corn production estimate by 3 million metric tons up to 86.3 million metric ton. A little bit surprised they did not offset that with a decrease in U.S. corn exports. I think that's the real risk going forward, and one reason my export target continues to be lower than USDA. Chinese corn production also increased by a little more than 3.5 million metric tons. So overall, that explains the corn export increase. On soybeans, USDA's ending stocks estimate for the world is still higher than mine, because I have a 54 million metric ton production estimate in there, which is a number that I've come up with my analysis, and that's basically in agreement with our Argentine team as well. I should mention on corn, our Brazilian team for Brazil corn production is at 91.1 million metric tons. So another 5 million, well, 4.5 million anyway, above where USDA currently is. But it's pretty early yet. We haven't even planted the safrinha corn crop yet, and that's where much of the increase in production comes. Now, as we look at global corn ending stocks, you see here on the right half of this pie chart, just under half of those corn stocks are from China. And of course, China right now is largely absent from global trade. We know we have a lot of stocks here in the United States. A little over a fourth of the world's stocks are from the United States. So that means virtually 3/4 of the global surplus corn stocks are in China and the United States. So what about the rest of the world? Well, I asked Lacey to put together this chart for me. The blue bars showing global corn stocks over the last 20 years in terms of days of supply. And you can see that over the last 3 years, we've been pretty stagnant at about an 80-day supply of corn. Not overly burdensome. If we go back to the mid-80s, we were at about 165-day supply of corn. So about half of that level. But we live in a world that's very comfortable just-in-time supplies, and that's more than enough to meet that demand. But if we remove China and the United States, global corn stocks are close to a 40-day supply, just over a 40-day supply, roughly half. And so the surplus is much smaller. It's a lot more hand-to-mouth than the rest of the world outside of China and the United States. That's why this is such a big year. We saw a significant expansion of production in other countries, but largely because of currency exchange rates and the tightness of supplies elsewhere that keep prices up. Brazil, probably looking at least a 10% increase in area once we expand the safrinha corn crop area, as long as the weather is cooperative and prices stay where they are. Argentina, probably looking at better than a 20% increase in area, the same with South Africa. So if the weather is conducive, we will increase stocks in these areas outside the United States, which will take export business away from us, which is why my export target continues to be smaller in USDA. On the other hand, if we have a repeat of last year's adverse weather, then we send more export business our way. We draw stocks in the areas of the world outside of China and the United States even tighter, and we start to draw down our surplus somewhat. So this is our critical window of opportunity if we're going to get higher corn prices, because if we have favorable weather in the southern hemisphere during the current growing season all the way through, then we start building those surpluses, and it's a longer period of time before we start tightening up supplies to bring prices back up on a sustained rally. If we look at the United States, where that corn is used, you see the bulk of it is basically used for food, seed, and industrial use. That would include primarily food use and ethanol production, and then seed is in there as well. Big chunk of it feed and residual. So if we were to have a short crop, that means that the areas that would need to get rationed of supply, or demand, are more difficult to ration because exports account for a relatively small percentage. But that also means that in times of surplus, our opportunity for getting rid of it is through exports, and it's a relatively small percentage. And so that means surpluses are harder to get rid of, and times of shortages require higher prices for rationing. Turning the page a little bit to soybeans, here again we continue to monitor this somewhat exponential growth of Chinese demand for soybeans, and of course exports or imports as well. Seen that chart before. When we look at U.S. exports, here again we see the tendency of USDA to underestimate soybean exports in this December crop report. So therefore ending stocks tend to fall considerably below USDA's December estimate. So in this case, we see that a little over 75% of the time over the last couple of decades, more specifically 16 out of the last 21 years, the December crop report overstated ending stocks by an average of 92 million bushels. Now let's look ahead to the 2017-2018 marketing year. And this is going to change a lot, but this gives us a first snapshot look at some possible scenarios for the coming marketing year. In the first most likely to happen scenario, you see at the bottom, I used a 170 bushel yield. That's a little bit of a high trend yield, but we've been tending to be a little bit on the high side of late, and USDA has already come out with the indications that it'll probably be a little above that. I think 170.6 or 170.8. I used 91.5 million acres. That's down 3 million acres from this year. And in the end, I come up with 2.5 billion bushels of corn. So that's still a lot of corn, very similar to where we are this year. That would suggest a marketing year average cash price, on-farm cash price, right around 305. Now, what happens if we cut acres a little bit less, so we have more acres? We only cut them about 1.5 million down to 93 million acres, and we get a yield of 175, just a little bit smaller than this year's yield. Well, that takes stocks up to 2.7, and yes, I did adjust demand somewhat on here, because the higher the stocks, the cheaper the prices, the more that's going to encourage demand, and the opposite is true as well. So we get a marketing year average cash price of 285. On the other hand, let's drop the acres all the way down to 90 million, and I think that's a real possibility here. Maybe we'll even end up lower than that, and a yield of 165. That's not that long ago, not that many years ago, since we had a yield at 165 or lower. That ends up dropping stocks down to 1.5 billion bushels and really suggests a marketing year average cash price of 460. So really, if we want to get higher corn prices, we need to drop the acres down considerably and see the yield decline as well. Yield we obviously have less control over because that's more related to weather. Acreage decisions we have more control over. Now, what about soybeans? This gets a little bit more interesting because it shows the fact that we have such strong global demand for soybeans that we're in a position where we have to continue to increase production. Excuse me. I've been talking quite a bit today. In this scenario, I come in with 87 million acres. So we're increasing acreage by several million acres and a 47.5 bushel per acre yield. That would be down about 5 million bushels from where this year's yield is at, and basically where our trend yield would be. That would be expected to draw down ending stocks to 285 million. And I was fairly conservative in my increase in exports, and I held crush pretty constant because I really believe we're close to capacity on crush right now. So not a lot of leeway for increasing demand there. It has to come from the export side of things. On the other hand, in our middle category here, if we increase acres up to 90 million, and I do think this is a possibility once again, and we boost the yield, well, we have a repeat of this year's nearly ideal conditions of 52.5 bushels per acre, then we could really see stocks soar, 770 million bushels, marketing your average cash price well below $9, maybe in the 860 area. Now, let's make things a little bit more interesting. A little less than maybe a 1.5 million acre increase, so very small increase, and a little bit of weather adversity, not too significant, but dropping yields of 45 bushels. Ending stocks, 131 million. That includes some rationing of demand. It's very tight supplies. And all of a sudden we see the marketing year average cash price average 1285, but that would include probably a more significant spike to much higher levels. It's just that not that many soybeans would be sold at those higher levels. So the average wouldn't be higher than that. As we look at, and this is the critical component now, would be the weather. That's going to make the big difference because the scenarios I just gave you are assuming normal South American weather. What if it's not? And that's a legitimate risk in which faced. First of all, look at the bottom graphics here. This looks at those analog years, other similar years where the dynamics driving the weather pattern was as close to possible as identical this year. So very weak La Nina, and then looking at sea surface temperatures in the other critical areas of the South Pacific and Southern Atlantic, looking at those years and what happened. And you can see there's a pretty dry bias, a little bit of a dry bias for Argentina for January, and some areas in March, a little bit mixed in February. But look at Brazil. Now, during this period of time, some of these areas in Brazil get over 10 inches of rain a month. They could have half of that amount of rain if it's distributed evenly and nicely and still get high crop yields. But if it all comes at once, the remainder, they're down half, and it all comes one night, which is sometimes the case, then you're pretty dry, and crop stress is a real issue. Now, Commodity Weather Group's forecast is not as dry. They expect to see a little bit more rain in there, but that's what we're dealing with. If this were to play out, then that would be expected to be quite bullish to soybeans and to some extent corn as well, for the reasons I've already outlined. Now, what are your take-home points? Corn stocks are large at 2.4 billion bushels, and wheat is equally large at 1.1 billion bushels. Soybean stocks are adequate unless we see a significant South American weather problem. Keep that in mind. If we see a significant weather problem, then stocks could find themselves too tight, and some price rationing may be needed. On the other hand, if the weather continues to cooperate, conditions are nearly ideal right now in Brazil, a little bit on the dry side in Argentina, but it's very early. So keep your eyes on South American weather. A repeat of last year's South American weather problem with tightened stocks amid the robust demand, necessitating price rationing. It's still a big if at this point, but something we must respect. Corn stocks are likely getting larger if South American weather problem doesn't develop. Here again, that's a big if. That can have a big impact, with almost 2/3 of Brazil's production being the safrinha crop, and the bulk of that goes in the export market. So at this point, I'm going to open it up for questions. I should say, while you're getting your questions ready and getting them entered on your screen, that I've also taken a look at the wheat ending stocks. I do see a significant reduction in acreage for wheat. I didn't put it in here because I want to see our client survey come back on wheat acres yet before I nail down what I think we'll see in the way of reduction of acres. It is safe to say that at this point I do see a sufficient reduction in acres to start pulling stocks down, but they still remain large overall. So let's take a look at questions. We have some already here. So the first question from Kanish, I hope I got that close. Do you think EPA new president will act against biofuel mandates, and will it impact soy oil prices? I've been getting that question quite a bit over the last few days. And we're really getting a mixed review on this. In some cases, we're seeing some indications that support for biofuels is going to be solid. In other cases, it's the opposite. I think it's something we need to be concerned about, but my personal bias at this point is that President-elect Trump has bigger issues that he wants to fight at this point, rather than taking on those Midwest states that supported him so strongly. So at this point, I'm cautiously optimistic that we will see continued support, but I think this is something we need to watch very closely. Daniel, hello to you. It's been a while since we've talked. I remember visiting with you over the years. Daniel says, with world stocks of grain at an all-time high, would a weather scare such as dry weather cause a short-term rally? Would you expect a longer-term rally extend through 2017-18? If we would have a repeat of last year's weather problems, I would anticipate a more significant rally of soybeans as well as corn, probably lasting into the summer, to make sure that we had sufficient expansion of acreage and that the crop was well enough established. Esteban, hello from Argentina. The price included export tax because in January the governor government took it off. My understanding is that he delayed removal. He did reduce, but delayed removal of export tax for soybeans and the soybean products. We'll have to look back into that. David, any thoughts on cattle and hogs? Well, short term, I think the good news is for the hog market, we've seen a response in the cash market. We're actually packers with pretty nice margins right now are having trouble finding enough hogs and are really bidding up the price. And we've seen the cash market really surge. What is it? We've been up about better than $6 this week. And exports for hogs have been pretty good as well. Surprisingly good considering the strength of the dollar. So that's been a positive. As we go into the first of the year, we have 2 more packing plants open up. And at these margins, that should increase the competition as well. So a little bit more positive there. When we look at the beef side, USDA did make a few adjustments in its balance sheet, but ending stocks basically remaining the same. I think the real concern is the fact that we're not seeing the lower prices being offered to the feeder being passed along to the consumer. And so we're not seeing the consumer have an ability to respond to the lower prices by increasing demand, and the strong dollar is making it tough for us to compete overseas. Now, the export numbers for October were better than I expected. They were pretty good. But overall, I think when we look at the slaughter rates, there's some real concerns about how high we can go with this market until or unless we improve domestic demand. Okay, Garrett. Any cheap, creative, low-risk plays on a South American weather if? Well, I have to be careful here because of how we're structured under Dodd-Frank. I cannot make the specific recommendations. So I need to be somewhat careful there because compliance is watching. Hi, Richard. But I would say that overall that if you're a producer, you simply need to be watching your downside risk if no weather problem develops, but keep your top side open in case it does. And most experienced traders know how to translate that into something that will work for them, and they know the tools to use that they're comfortable with. But I really think that this is a market that could see considerable volatility if a weather problem develops. But that's still a big if. When I look at those graphics that I showed you, what the analog years suggest as far as dryness for the month of January, February, March, it reminds me a lot of the maps that I saw from the analog years for the Midwest for late July and August for this last growing season. And those problems never did develop. So it is not a guarantee. And of course, we saw what happened to the markets when they didn't develop. So that's probably all I better say in light of compliance. DB, likelihood of a 4 million acre shift to soybeans. I'd say the likelihood is pretty good right now because of the drop in wheat acres and the drop in corn acres. We're hearing more and more of that. Once again, I'm surveying our clients right now and what they see in their areas, but I'm penciling in at least a 3 million acre reduction in corn at this time, with much of that going to soybeans, and wheat acres could be down 3 to 4 million, maybe 5 to 6 or even 7 million, waiting to get the survey results back there. But beans will pick up a big chunk of that, and especially as we look at some of the areas where they could see some pretty good production. We are looking for a significant need for soybeans and soy meal protein over the coming year, but right now I see production, assuming normal weather in South America, right now I'm seeing production in the U.S. expansion of acreage being probably sufficient to meet that, but prices need to stay high enough to make sure that happens. Lincoln, how can farmers continue to produce grains at prices below the marginal cost of production? Is there a point at which farmers can't keep producing at these low prices, or can farmers continue to see losses? They can until they run out of money. And that's where the bankers come into play and forcing them to pull back. But it's within the farmer's nature to plant. And he is an eternal optimist. That's what it takes him through the adversity. So for the near term, he's going to continue to plant. The market, and I showed you the graphics earlier, the market is trying to say, don't plant, especially for corn and wheat. But he's going to plant. Hopefully fewer acres, but he's going to plant. David, who will be the USDA secretary? Oh, there's been a number of candidates in, and Donald and I haven't talked about that when we've gotten together for dinner, so I'm not sure. Your guess is as good as mine. I really, I'm known for giving my opinion, but that's one I just do not have an opinion on. I hope it's somebody who has a good understanding of agriculture, and I'm encouraged by the fact that most of his cabinet picks at this point have been people very knowledgeable in their respective industry. So I anticipate that's what he's going to do here as well. Donatus, I hope I said that right. Is it possible for Australia to export 24 million metric tons? Port capacity and structural issues could be an issue there. But I think it is possible. We'll have to see. I'm not familiar enough with all the port and infrastructure issues there that could be a concern. But yes, I do think it's possible. David, do weekly corn inspection numbers paint a different picture than do weekly export sales at this time? Yes, they do. Export sales at this point for corn suggest that we will exceed USDA's target by nearly 100 million bushels. While actual shipments marketing year to date are a little bit behind the pace. Now, I'm not too concerned about that at this point, although if we have a normal crop, normal weather, and get a big yields in South America with expansion of area, I do expect many of those sales to get shifted to South American origins. That's why my export target is smaller than USDA, because I have to assume normal weather. If it's not normal, repeat of last year, then we'll export that plus more. Don asks, what do you expect from the Trump administration going forward and how that affects agriculture? I'm putting together a whole presentation on that, which I'll be giving at many of our client events, to those of you who are clients. But basically, as I look forward, I'm looking for some move for tax and regulatory reform that unleashes our economic engine here in the United States and to some extent globally. And that in turn is good for the stock market. And when you combine that with the strength of the dollar, is very tempting for the funds then to simply shift money away from the grains, away from the commodities, and toward the stock market. So that tends to have a negative impact on grain prices overall. When it comes to specific agricultural policy, there is some risk toward some trade disputes that could disrupt trade, but at this point, I'm not expecting anything of significance affecting the food-based commodities. It is something we certainly have to respect and something I'm wary of. But I think the battles in trade will be with non-food commodities for the most part. And I'm having studied to some extent Donald Trump and his tendencies. He tends to make statements that position him for the negotiation, but tend to be very practical then in the negotiation. So I'm going to be cautiously optimistic, but I think this is the biggest unknown right now from the Trump administration. Certainly, agriculture would benefit from tax reform. Certainly, agriculture would benefit from regulatory reform. I think agriculture probably overall should be pleased with his selection for the EPA chief, assuming that they choose not to take battle with the biofuel industry. Hopefully, this will reduce some of the regulation for farmers that may be somewhat cumbersome and lower impact. But that would be a quick overview of what I see in regards as I make observations about this. Chinese soybean imports in December and for the whole of 2016-17. I don't have my specific numbers with me, and my mind's gone blank right now on what those are. But generally, right now, I'm looking for total soybean exports to come in at least 50 million bushels above where USDA is. I do see an earlier harvest than normal in South America, specifically Brazil, and because of currency exchange rates, I think China will quickly shift to those Brazilian supplies. But I still see the demand for U.S. soybeans being very strong. China continues to aggressively buy and take shipment of U.S. soybeans at faster than the normal seasonal pace that we would expect. And final question, unless somebody else comes in here quick, John asks, what are the odds that there are 6 million less corn acres next year? Well, I don't know about being an odds maker on this, but I will give it kind of my best educated guess. And I would put the odds of 6 million or greater fewer corn acres this year at probably about 30%. So that's large enough that it needs to be respected, and I think would go a long ways toward reducing our surplus supplies. But at this point, I'm looking for something close to 3 to 4 million acre reduction, largely because the American farmer says he's going to reduce corn acres, but then when the time comes, he still loves to plant corn. That's what he loves to do. Another question here, port capacity is only one part of the story. What about prices? Australia is, okay, what about prices? I'd have to look back at the FOB prices of Australia right now. We're probably going to see quite a bit of Australian wheat go into, of course, its normal Asian markets. Certainly India, removal of tariff opens up more exports, primarily Australian, some probably from the Black Sea. But overall, I still think that they're going to end up being competitive in the end. Jeff, with increased soybean stores and capacity crush met, where do you see the soybean oil market going for 2017? Certainly, if we stay with the current RFS standard, that should support good demand for soy oil. But maybe not as strong as what a lot of people see. Immediately the markets, when we got the RFS update, markets bought soy oil aggressively, saying this is a lot of demand. Soy oil actually has a little under 50% of the share of feedstock going into biodiesel. And it has to stay competitive. And that rally that we saw immediately after the announcement really made it difficult for soy oil to continue to rise. So I think what it does is it provides support underneath of the market, but I think the upside is somewhat limited unless we get a more extensive threat to South American production that really threatens supplies, and then the market tries to ration the demand. Otherwise, I think we start to establish a sideways trading range in here. That looks like it wraps up our questions, and thank you for being back with us. And of course, the January report is the big one of the year. That's when we have the quarterly stocks report. Typically has some surprises in it for the January report. Final 2016 production estimates for the summer crops, updated domestic and global supply and demand balance sheets, and that wheat winter seedings report as well. So almost always some surprises in that January report. I hope you have a happy holiday period and a happy new year coming up, and we'll be back with you in January. So until then, be careful, stay warm if those of you here in the Northern Hemisphere, and stay safe. We'll be talking to you here in a month.